By the way, it's the exact same problem here. If you look at 10 billion AUM for Bitcoin ETFs amongst BlackRock and Fidelity and these other Bitcoin trusts, well, what does that translate to? 200,000 Bitcoin being in the hands of a small group of actors who are regulated. They have the exact same power as Circle now with Bitcoin. As more of these legacy actors come in, they'll acquire more and more of the supply. They already have a fifth of what Satoshi has. Remember the panic scenario in Team B? Team Orange keeps saying, what if Satoshi comes back and sells all of his coins? Well, you have just invited in some of the richest, most powerful multinational globalist organizations to own 200,000 of your coins.
Amidst the burgeoning enthusiasm within the cryptocurrency sector surrounding the introduction of Bitcoin ETFs, dissenting voices have emerged, arguing that this development contradicts the very essence of the industry. Charles Hoskinson, the founder of Cardano, recently expressed his concerns regarding the involvement of major Wall Street entities such as BlackRock and Fidelity in the cryptocurrency market. In his video titled Legacy is Eating Crypto, Hoskinson contends that while the industry appears to be embracing Bitcoin's entry into mainstream finance, it is, in fact, allowing the infiltration of the corrupt legacy system into the realm of Bitcoin and crypto. Approximately 2 weeks ago, analytics firm K33 Research revealed that 9 newly launched ETFs had accumulated over 200,000 Bitcoin, valued at around $9.5 billion at that time. This milestone was achieved in less than a month of trading. While the approval of Bitcoin ETFs and the subsequent accumulation of Bitcoin have driven crypto asset prices to new heights, with Bitcoin surpassing $50,000 for the first time since late 2021, Hoskinson warns against the industry's fixation on price gains and its disregard for the risks posed by these financial products. He cautions that this short-sighted focus could spell doom for the entire industry in the near future. During his recent YouTube upload, Hoskinson also highlighted the potential threats posed by asset-backed stablecoins like USDT and USDC. He argues that these stablecoins, along with other regulated assets, pose significant risks to the ongoing development and autonomy of the cryptocurrency industry.
Please take a moment to like this video, subscribe to the channel, and don't forget to drop your comment and observations in the comment section below. Thanks and enjoy the video.
So recently I was on several different podcasts and I made the point that algorithmic stablecoins are an essential thing that we need to, as an industry, look into, and that asset-backed stablecoins are a little problematic. So this comes from PowerPoint that's produced internally, but I wanted to share it because I really, really like this data from Coinmetrics and Illumium. So anyway, stables represent about 10% by value of the crypto market cap, of which USDT and the USDC are the overwhelming majority of those things. Okay, but they dominate the on-chain transaction volume, about 70% of all transaction volume. So from a crypto perspective, ETH and Bitcoin take a backseat to USDC and USDT. These are, by volume, the value transfer mechanisms of our industry. They represent the huge majority of on-chain traffic and value transfer in our industry. Now, there's something about these two guys, USDT and USDC. They are asset-backed. Very important term, asset-backed, which means that there are two properties you can't get away from. One property is that there's a central issuer. There is a company who is regulated in a jurisdiction, subject to that jurisdiction's rules and regulations, and whatever that jurisdiction wants to put upon that company, permissive or otherwise, they are subject to it and cannot get out of it. They're a business like a bank or anything else responding to that regulation. And I'm not diminishing or saying they're bad actors and that they're evil people or something. I'm just saying that they exist within a jurisdiction. They're subject to regulation. Crypto does not. Crypto is a global asset. The people who hold it are subject to their local regulations. So if you're in Estonia, you're subject to that. If you are in South America and Argentina, you're subject to whatever it is there. And of course, the United States, you're subject to that. And if you do business with a US person, then suddenly you're now under US jurisdiction. But Bitcoin as a protocol doesn't wake up in the morning and say, I follow the US law. A stable coin that is asset-backed does. There's no way to get around that. And the top two basically have to follow, for the most part, what the US government says. even if they're running away from it a little bit, like Tether, they still, at the end of the day, they can't push too far in one direction. So that's the first set of problems with asset-backed stablecoins. The second set is they can't go fractional. And that's a good thing. But with a hard fork, let's say there's Bitcoin splitting and there's Bitcoin A or Bitcoin B, or more pertinent to this example, Ethereum splitting, Ethereum A, Ethereum B. You can't have a situation where the stablecoin issuer says, you know what? I'm going to let my stablecoin be on both sides and we'll just let it ride. Why? Because doubling the supply means that they're only backed by 50 cents to the dollar. They have to pick a winner. They either pick A or they pick B. A or B, but not both. They can't pick both by design. If 70% of all your transactions, all your value transfer is occurring at that stablecoin level, and your entire DeFi economy relies on that, you can't be the chain that suddenly loses USDC or Tether. You have to be the other chain. So what if they split and one says we're going to put KYC into the whole system, and the stablecoins support that split, and the other side, well, they just lost your stablecoin. Means they lost all their liquidity. They lost all their DeFi backbone. What do? That property forces them to pick a winner. You have now implicitly given to the stablecoin issuer, the asset-backed stablecoin issuer, that power. A small group of people you've never met, you have no relationship with, you didn't elect them, they have nothing to do with your underlying asset. They have that power, that authority now.
Hoskinson asserts that algorithmic stablecoins offer a superior alternative, as they are not bound by the same constraints as asset-backed stablecoins. He explains that algorithmic stablecoins rely on other crypto assets and on-chain algorithms, which oversee the entire process without being solely controlled by a centralized entity or regulator. Hoskinson rebuffs critics who cite the collapse of Terra Luna as evidence against algorithmic stablecoins, arguing that one isolated incident should not condemn the entire concept. In his video, Hoskinson also critiques the widespread celebration of spot Bitcoin ETFs, highlighting the significant risks posed by centralized custody, contrary to the optimism expressed by many other cryptocurrency investors. Unlike those who solely focus on price appreciation, Hoskinson remains cautious about the number go-up arguments put forth by pro-ETF Bitcoiners.
By the way, it's the exact same problem here. If you look at 10 billion AUM for Bitcoin ETFs amongst BlackRock and Fidelity and these other Bitcoin trusts, well, what does that translate to? 200,000 Bitcoin being in the hands of a small group of actors who are regulated. They have the exact same power as Circle now with Bitcoin. And you have all the Team Orange running around saying, well, no, they don't. The miners are in control. Okay, well, let's go do the experiment. You fork and you have Bitcoin Chain A and Bitcoin Chain B. And the ETFs say, you know, we support Chain B. So what do? They take whatever assets they have that have just been replicated in Chain A and they sell all of it. What does that do to the price of Chain A? It goes into free fall. And you know what happens is the miners, they say, well, same hash power, but if I mine A, I get 25, 50, 60% less than if I mine B. I'm just going to move over to B. Hash power falls. The dominant chain is Chain B. As more of these legacy actors come in, they'll acquire more and more of the supply. They already have a fifth of what Satoshi has. Remember the panic scenario in Team B? Team Orange keeps saying, well, what if Satoshi comes back and sells all of his coins? Well, you have just invited in some of the richest, most powerful multinational globalist organizations to own 200,000 of your coins. And you've done it. Happy, 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 joy, joy. Every day. You're fired up about it. Why? Because number go up. Then you look at the centralized exchanges. They get to decide list A, list B. You see the trend here? So hang on a second here. How many big exchanges do we have in crypto? The top three control the vast majority of our transactions and trade by dollar value. Small group of ETF holders, small group of centralized exchanges, two big asset-backed stablecoins, which constitute 70% of the value transfers. Sum that up, 10 legacy regulated institutions control the vast majority of your value flow. and also get to decide the future of all of these projects. Why? Because if you go in a different direction, they won't list you, they won't give you a stable coin, and they'll dump your coin if you go in a different direction for a project that you love. You tell me, is crypto eating legacy or is legacy eating crypto? This is something Cryptocurrency Reddit can't understand, because the only metric that matters is number go up, anything mentioning my name bad, and Cardano is a scam. Lo and behold, we're one of the few ecosystems that managed to stay a little bit out of the fray because we weren't a VC Ponzonomic coin. We just organically grew. And for the most part, most of Wall Street has ignored us. For the most part, most of that legacy infrastructure hasn't paid too much attention, and we've had organic TVL and organic growth. Now, the community is starting to invite the vampires in. It's not my job to say it's a good thing or a bad thing. It's my job to go ahead and say I have concerns, and to let people know that when these people come in, they gain a lot of power and influence. They get to decide your level of transactional privacy, your custodial standards. What is a wallet? What are your listing criteria and the governance therein? What chains are legitimate? What chains are not? What consensus is legitimate? What consensus is not? Who gets liquidity and who doesn't get liquidity? Which jurisdictions? And dozens of other things. They get to decide all of that. And if they decide that you're not worthy, like Monero getting delisted with most of the modern exchanges, it's shit out of luck. Is that the revolution we signed up for? To have 10 companies come in and completely take over cryptocurrencies and basically run them and control them? I didn't sign up for that. I don't think a lot of people did. But if your only criteria is number go up, that's what you get.
Hoskinson wrapped up his video with a solemn reminder that market participation should be free from the specter of censorship and exclusion, emphasizing these principles as the foundation of the cryptocurrency revolution. He cautioned against relinquishing these principles to legacy actors, urging viewers to reflect on his message. What are your thoughts on Charles Hoskinson's video and his stark warning for cryptocurrency investors? Meanwhile, Hoskinson isn't alone in issuing warnings about Bitcoin ETFs. Renowned Bitcoin advocate Max Keiser has also voiced concerns about exchange-traded products based on Bitcoin. Keiser recently highlighted a tweet from New York Attorney General Letitia James regarding the potential seizure of former President Donald Trump's assets. Keiser extrapolated from this, suggesting that if such actions can be taken against Trump, then Bitcoin held within ETFs could similarly be targeted. He stressed the importance of self-custody for Bitcoin miners to avoid potential confiscation by government entities. Keiser has previously made bullish predictions for Bitcoin's price while forecasting a market crash for traditional financial assets. Despite these warnings, many investors remain enthusiastic about Bitcoin ETFs due to their perceived positive impact on prices. What are your thoughts on the concerns raised by Hoskinson and Keiser? Do you believe we should exercise more caution regarding the involvement of large traditional financial firms, or do you appreciate their role in expanding crypto accessibility to a broader investor base? For more Daily Dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.